Hey everyone, welcome back to Corporate Decoder, the place where we unpack the complex world of business, and today we're diving into Phunware's latest 10Q report. Let's just say their financials have a few interesting twists and turns, and we'll explore what that means for the company. Before we jump in, if you are looking to get a clear picture of what is really going on behind the scenes in the corporate world, make sure you are subscribed. And hey, if you want to connect with other finance enthusiasts and dive deeper, join our Discord community. The link is in the description below. Alright, Phunware Incorporated, you know them. They're the folks trying to make our mobile experiences smoother with their software platform. This is their quarterly report, the 10Q, giving us a peek under the hood for the period ending the 30th of September 2025. Now, normally these reports can be a dry read, but we're here to find the juicy bits, the numbers that tell a story, and what they actually mean for the company. Let's start with the balance sheet, which is like a snapshot of what the company owns and owes at a specific moment in time. Looking at the 30th of September 2025, Phunware has about $105.6 million in total assets. That is a pretty solid number, but it is down from $114.7 million at the end of 2024. They've got over $103 million in cash and cash equivalents, which sounds great, but their total liabilities are around $7.3 million. So on paper, they seem to be in okay shape, but the decrease in total assets is something we'll want to keep an eye on. Now for the income statement, or as they call it here, the statement of operations, this tells us how much money they made and lost. For the 3 months ending the 30th of September 2025, they brought in $622,000 in net revenue. That is down from $665,000 in the same period last year, a slight dip. But here is where it gets more interesting a bit longer term. For the 9 months ending the 30th of September 2025, their net revenue was $1.765 million, which is a significant drop of 32% from $2.597 million in 2024. They specifically mention a decrease in advertising campaigns, which is a big part of their business. Losing over $800,000 in revenue in 9 months from advertising alone is a pretty big deal and shows a weakness in that part of their strategy. When we look at the cost to produce what they sell, that's cost of revenue, it dropped as well, about 27.5% for the 9-month period. This is mainly because their advertising revenue went down. Because of this, their total gross profit for the 9 months ended the 30th of September 2025. Fell pretty sharply by 36.5% to $836,000 compared to $1.316 million in the prior year. Their total gross margin also dropped from 50.7% down to 47.4%. This basically means the profit they make on each dollar of sales is shrinking, which is never a good sign. Now let's talk about how much they're spending to run the company. Their sales and marketing expenses went up by about 29% for the 3-month period and a hefty 42.8% for the 9-month period. They say this is because they're investing more in their sales team after some cost cuts in 2024. That is good for growth potentially, but it also means they're spending more to bring in less revenue, at least in the advertising segment, which is a red flag. General and administrative expenses, which covers things like salaries for support staff and legal fees, went up by 21.4% for the 9-month period. They specifically mention a big jump in legal fees, partly due to their ongoing Wild Basin litigation. This is not ideal. They are spending more on lawyers while revenue is dropping. Research and development expenses also saw a significant jump of over 54% for the 9 months. This is tied to their investments in artificial intelligence or AI. They believe this is crucial for their future. They are developing AI concierge and guest services agent features. While investing in AI could be a smart move for the future, it's a significant expense, and right now, it is adding pressure to their bottom line. On the bright side, their other income section looks decent. For the 9 months ended the 30th of September 2025, they had about $3.3 million in other income, mostly from interest on their cash. This is up from $1.3 million in 2024. They also had a gain on extinguishment of debt in 2024, which was a one-time boost. The increased interest income is likely due to having a larger cash balance, probably from past stock sales. All of this results in a pretty substantial net loss. For the 3 months ending the 30th of September 2025, they lost $2.4 million. And for the 9 months, the net loss was a massive $9.3 million. This is a worsening situation compared to a loss of $7.7 million for the same period in 2024. The earnings per S-share, which is how much loss is attributable to each share of stock, reflects this. It's a negative 12 cents for the 3 months and a negative 46 cents for the 9 months. It is important to note that their diluted loss per S-share is the same as their basic loss. Per S-share, this means that all the potential shares from things like stock options and restricted stock units don't have a diluting effect. Essentially, there are so many potential shares that if they were added in, it would make the loss per S-hair even bigger, which is not good. Looking at their business segments, software subscriptions and services revenue held steady for the 3-month period, actually increasing slightly as a percentage of total revenue. This indicates some stability and potential resilience in this core part of their business. They focus on healthcare and hospitality, which are solid markets. However, the advertising segment is a different story. For the 9 months, it saw a huge drop, a massive 78.4% decrease in revenue. This is a major concern and clearly a weak point for the company right now. They blame softening market demand and issues with advertising agency partners. Let's talk about backlog, which represents contracted work not yet billed or recognized as revenue. The total backlog and deferred revenue combined is about $4.77 million. This is down from over $5 million at the end of 2024, suggesting that new contracts might not be keeping up with the work being completed, or that existing contracts are expiring. Now, Phunware also uses something called adjusted gross profit and adjusted EBITDA, which are non-GAAP measures. They use these to try and show their operating performance without certain expenses like stock-based compensation. For adjusted gross profit, it is still down for the 9 months, so even with their adjustments. The profitability on their core offerings is decreasing. Their adjusted EBITDA, which is basically earnings before interest, taxes, depreciation, and amortization, is also showing a significant loss, and the loss widened considerably in 2025 compared to 2024. This means that even when you strip out some of the usual expenses, the company is still losing a lot of money. They're spending more on sales and marketing, about 29% more for the quarter and 42% more for the 9 months. This is supposed to drive revenue growth, but with revenue declining, especially in advertising, it raises questions about the effectiveness of their sales and marketing spend. It seems like they might be spending more to get less. The jump in general and administrative expenses is largely due to legal fees, which is understandable given their ongoing lawsuits. They are facing a lawsuit from Wild Basin Investments, and they also have a pending arbitration with their former counsel, WSGR. These legal battles are costly and a significant drain on resources. Scroll net revenue decreased $0.8 million, or 32.0%. T-Gallery, the steep decline in net revenue, particularly in advertising, is the biggest story here. While they point to market conditions, the sharp drop suggests potential issues with their advertising strategy or client retention in that segment. They are relying more heavily on software subscriptions and services, which is good, but that segment alone is not enough to offset the advertising decline. Scroll net loss. Phunware, the widening net loss, is a clear indicator of the company's financial struggles. They are spending more on growth initiatives like AI and sales, while their core revenue streams are under pressure. This is a tough balancing act. Scroll litigation. Phunware, the company is involved in some pretty serious legal situations. The Wild Basin litigation and the WSGR arbitration are ongoing and could have significant financial implications. They are hoping to settle these through mediation, which could be a good sign, but the outcomes are still uncertain. Gallery, our future performance will depend on the successful transition of our Chief Executive Officer, CEO Swin Gallery. Leadership changes are always a point of discussion, and Phunware has had its share. They replaced their interim CEO, Stephen Chen, with Jeremy Kroll in July of 2025. They acknowledge that a smooth transition is critical for their future performance. These changes can bring new strategies and perspectives, but also create uncertainty. Now let's look at cash flow for the 9 months ended the 30th of September 2025. They used $9.3 million in cash from operations. This is consistent with their net loss as expected. The good news is they have about $103 million in cash, which gives them some runway. However, that cash is depleting due to the operating losses. Scroll, our future performance also will continue to depend on the services and contributions of our other senior management and key employees, iGallery. Overall, Phunware is at an interesting crossroads. They are heavily investing in AI, which could be a game changer if successful, but their core advertising business is struggling significantly, and they are facing substantial legal challenges. The increase in sales and marketing spend while revenue declines is concerning, and the widening net loss highlights the pressure they are under. They have a decent cash reserve, but it is being consumed by these operating losses. Their strategy seems to be a bet on AI to revitalize the company and boost future growth, but the current financial performance suggests they need to find a way to stabilize their existing revenue streams, especially advertising, or significantly improve the profitability of their software services. Without that, even their AI investments might not be enough to turn things around. That is our breakdown of Phunware's latest filing. What do you think about their AI bet and the struggles in advertising? Do you see a path to profitability for them? Let us know your thoughts in the comments below. If this analysis was valuable, please give it a thumbs up, it really helps us out. And of course, Subscribe for more deep dives into corporate filings. Don't forget to check out the Discord community linked in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.